Welcome to an awesome edition of Rebellion's educational series. I'm here with the brilliant fund manager, Leland Abrams. I've known the guy 30 years. He was a star at Goldman Sachs. Now he has his own fund running a ton of money. The man understands mortgages to the nth degree. So thankful to have him on. Thanks so much, man.
Thanks for having me, Alex. I think you confused me with my twin brother about the Goldman thing. I didn't work at Goldman. My twin brother did.
Oh my God. It'll
Nonetheless,
happen. Well, it's great that we segue into that quickly. His twin brother is another great guy, Jared, who I've also known for 30 years. But, Leland is running a large fund now. Let's talk about mortgages. Where do you see the rate going?
Okay, so mortgages are interesting, and mortgage rates, obviously, we're coming off of historic lows. The funny thing is when we talk about rates and where rates are going to go, and it's obviously that's predicated on where the 10-year is going to go. You may have noticed yesterday the 10-year, and the last couple sessions actually, the 10 years rallied quite significantly, meaning that yields have gone down on the back of sort of mediocre jobs reports, essentially saying that we're not achieving that full employment target of the Fed, and that seems to be priority number one as opposed to price stability vis-a-vis inflation. So as a result, the bond market's kind of leading the way, has taken rates lower, contrary to popular belief. I think if you poll the universe of wealth advisors and a lot of people in the marketplace, they'll all tell you rising rates, and the bond vigilantes are going to win. Bond vigilantes are not going to win. Don't ever stand in front of the Fed. It's like standing in front of a freight train. You'll get run over. So you don't fight central banks. And central bank has made it abundantly clear rates are not going higher. He even said during his testimony, he was asked a question by Steve Leisman, who's the economist on CNBC. Steve asked him a question 3 times, 3 different ways about, well, what if the market basically gets ahead of, your targets? And he very clearly said, I will not let the market tighten in front of us achieving our goals. So does that say he's going to do or perform Operation Twist? Maybe, who knows? But it was very clear in saying, bond vigilantes, go away. You're wrong, and I'm in charge, and that's it. So for now, rates are sort of capped. What I've seen, and we've sort of been trading a range a little bit, kind of that 150 to 170 range on the 10-year, which portends a mortgage rate somewhere in the 3 area for the for traditional like Fannie Mae conforming loan.
So the average viewer of our show is a 30-year-old working in finance or technology. And if they're going to buy a house or an apartment in the next year, what would you advise them to do? What type of mortgage would you tell them to take?
Well, it depends. I mean, certainly, I'm in a different position than most.
Let's say the average guy puts down 20% and he's going to borrow 80%. What would you tell him to do?
The average person buying an average home in this country, let's call it a $500,000 home, which is actually above average, but let's say that's a $500,000 home. You put down 100,000, you borrow 400. That would be, you'd have a 30-year conventional fixed rate amortizing mortgage. For those who earn money, a lot more money, or looking for much higher mortgage amounts, if you're buying multi-million-dollar properties and you're financially savvy and you make money with your money, then I would always suggest to do an interest only, some sort of 7-1 or 10-1 ARM. I know some of the really good private banks are out there offering 2.5% interest only 10-1 ARMs. That means for every $1 million you borrow, you're paying about $2,000 a month, which is ridiculous.
That is very low. What about Better Mortgage? Have you come across them?
Better Mortgage? No, I have not.
They're an interesting technology firm that's trying to offer very cheap mortgages, and they've had tremendous success. I mean, there's so many mortgage fintech companies.
I'm
I think there are probably dozens of mortgage fintech companies. That's just one that came across my desk.
If you look at like what happened pre-crisis, I mean, all these mortgage, we call them specialty finance companies. And what they do is they borrow from Wall Street. They have a lending to have a warehouse line. They use that money to lend to you to write the mortgage. Immediately after the mortgage is written, they take that mortgage and sell it back to the investment bank who provided the warehouse facility to them, and then they package it up and bundle it. So mortgages, what's interesting, I'll dial back here a second. Do you know what the second largest market in all fixed income is? Behind US, so if US Treasuries are number 1, what would be number 2?
Mortgages, I guess.
Mortgages, exactly. It's sort of a trick question on mortgage guys. Yeah. So yeah, mortgages. But if you ask anybody that, I go on the road, we're road showing our mutual fund, these are two financial advisors. I would say resoundingly, the answer is always wrong. They say corporates, EM, municipals. It's like, no. Mortgages are 40% bigger than corporates. 12 plus trillion dollars of mortgage bonds outstanding. So mortgages are not.
Yes, quite frankly, if you hadn't led me into the question, I would have guessed corporate.
Okay, yeah, well, there you go. 40% bigger is the mortgage market, because the mortgage bond market, mortgages are financed by bonds at the end of the day. People, I think, have this very kind of simplistic idea with respect to how mortgages are originated, who's giving the money. It's not your bank around the corner who's giving you the money. That's not the way it works. So traditionally, mortgages, you have the three GSEs, Fannie, Freddie, Ginnie. The banks who give you the loan for that traditional, you're going to buy that $500,000 home, you borrow 400, you put down 100. They have a checklist, and they check off each thing along the list about your documentation, your job, your FICO score. You have to provide a lot of documentation to get a mortgage, and they're following the guidelines set forth by one of those GSEs. They issue the mortgage, and then that mortgage gets bundled up and financed by bonds ultimately. So at the end of the day, it's not banks' reserve capital that's issuing mortgages, except obviously some private banks will underwrite these multi-million-dollar type of interest-only products. Those are different, but by and large, the vast majority of mortgages are all financed by bonds.
Do you see anything of any shades of 2006, 2008 happening today?
No.
Why is it
And
different?
the reason is because of, there's several reasons. Then that was a speculative housing market. There was 4.5 million surplus homes. Today, 2 million deficit homes. So no matter what you really did, or how much prices are going up, et cetera, how fast they're going up, it's very, very different when you just don't have enough homes. And now with labor shortages, material shortages, you can't build them fast enough. We also, not only do we manage securities funds in the mortgage world, we also develop homes. So we have a really good insight into this.
Is there an area in the U.S., Leland, where you think maybe it's gotten overheated?
The numbers would tell you that maybe Florida is overheated, but from a political and economic and lifestyle perspective, I think it's got a lot of room to run. And I myself, I don't want to say I'm a victim, but I'm certainly someone who's taken advantage of that and moved to Florida myself.
But what about the recent jump in oil prices? Would that make you think that certain of the mid-northern states would start doing well again in the Dakotas?
I mean, those are small areas anyways. So in terms of like national impact, it's going to have a small impact. Oil prices are terrible for the average everyday consumer. It's a very regressive tax. Just like, inflation is a regressive tax. It's really, really bad for the poor, the working class. Rich people don't care. In fact, they enjoy it as they own tons of assets, typically. But housing, a couple interesting statistics. The housing market now has seen the highest number of all cash buyers ever.
Wow.
So
that is an amazing statistic.
What's behind that? Is that people cashing in their Dogecoin to buy homes? It could very well be. I don't know. I haven't really looked into it deeper, but it's pretty wild. And the other thing is, when you look at what happened with this recession in the COVID recession last year, the knee-jerk reaction was, oh no, it's 08 again. Housing is toast. But that was not the reality. Not only was it not impactful, it was extremely benign for housing, as we've had sort of this urban exodus and everybody fleeing to go to buy a single family home.
Look at Restoration Hardware stock. Oh my God.
Exactly. I mean, funny enough, we got some Restoration Hardware stuff for our house in Florida that we bought.
It's
stuff that we ordered in December, I still don't have yet.
Wow.
So, for whatever that anecdote is worth, it's worth something. So when March hit, some guys went delinquent on their mortgage, or some people went delinquent on their mortgages. And the reaction of the market was, oh no. But then we have to think about what actually happened. So the press has talked about throughout the summer last year into the fall, record number of delinquencies, highest delinquencies in a decade, highest 90 plus days. So, really bad delinquencies. And that was all sort of, I don't want to use the term, but I'm going to use it, fake news. It was all very, very misleading. What they didn't tell you was, of the mortgages that went delinquent last March, do you know how many have cured today, have gone back current?
Yeah.
About 80%.
Okay.
So those who went delinquent, 80% are now back online.
A lot of them just didn't feel
Nobody
like
talks
paying
about
or didn't want to pay.
Well, people didn't pay because you had television advertisements in states like New York telling you not to pay. Take forbearance, take a holiday, don't pay, save that money, tack it onto the end balance. So why not? I know a lot of people who did it. I didn't partake, but heck, if I didn't pay my mortgage for 3 months, I'm gonna save a lot of money, right? And stick it on the back end with no adverse impact on your credit, et cetera. So this was a lot of game playing by a lot of people. Then if you realize that your house is now going back up in value, you're certainly not going to default or walk away as it's your number one asset. So the whole thing kind of worked out pretty well. And then you saw this huge exodus from urban centers, people buying homes, scrambling to buy homes, both luxury homes, regular homes. I mean, look at Aspen, Palm Beach, Hamptons. It's absolutely crazy. So it's hitting all aspects of the market at once, and there just are not enough homes to satiate the demand. And then you've had a lot of wealth creation in the past year as well.
Can I ask a specific question? Why do you think LA has stayed so strong throughout the crisis with pricing, whereas New York got hit? They both saw a huge fleeing, but LA's demand has stayed where it was.
It's a tough question. It's probably more of a socio-political question.
So,
LA is more spread out. LA has a lot more single family homes, whereas New York City is obviously dense urban. New York City was on the spotlight with all that ridiculous looting and stuff that was going on last was it June. So I think from everyone I talked to, again, this is anecdotal, but I believe it to be right. People said you raise taxes on the rich, they're going to leave New York. They're going to leave. They never left. But when you have New Yorkers go to a fancy or a fine restaurant sitting on the sidewalk and getting attacked, layered with higher taxes, then they're out. So it was quality of life, I think, that made the biggest move in New York and this kind of quick exodus. And you also didn't have an influx of new blood into the city, post college or whatever, coming in and having 3 kids, hack up a little one bedroom. It just wasn't happening. So there was a lot of pressure downward. But now that we've, I was saying to a lot of people, look, as housing is going crazy everywhere else, this New York City kind of doldrum is not going to last long. You can see the snap of a finger and Manhattan prices are going to go back up, and it's exactly what's happening right now. Manhattan is hot again.
So got to ask about Texas. Do you have a view there?
I mean, Texas, I think, is in a similar boat to Florida and Tennessee. These are no tax states, and
Tennessee has really just seen fantastic influx.
Fantastic growth. So a combination of no state income tax and a freedom of those who are not into being told what to do by the government and basically having their businesses crushed, etc. People are fed up with that, and they've gone to certain states, I think, that appeal.
So reverting back to the individual lender, would you recommend they take a specialty finance company, or would you recommend they go to a traditional lender like a JP Morgan or Wells Fargo?
Well, JP Morgan, again, if you're getting a traditional loan, all those folks are doing is underwriting the loan according to the Fannie Mae guidelines. They're not actually issuing the debt. But if you're in the market if you want to have your traditional 30-year amortizing mortgages, yeah, you're going to go to Wells Fargo, JP Morgan, et cetera, big bank, because they're going to underwrite for the GSE loan, the Fannie Mae loan, and pricing should all be relatively the same or very competitive. If you're going for major loans, you should really look into the like interest only, exotic products. That would be more private bank stuff. Those are not securitized. Those are bank balance sheets. So that's like, that's your private high net worth banker at XYZ shop, whatever is the way to go. You can also always wise to sometimes use a mortgage broker who has, reach into all these different areas, and they can, fight to get you the most competitive product and rate.
Gotcha. Awesome. This has been a really fantastic conversation. Leland, as always, very informative, super smart, and I appreciate the time that you gave today.
My pleasure. Thank you, Alex.
You will.
Take care.